Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. In today's video, instead of breaking down a chart or looking at a trade scenario, we are going to be speaking about risk to reward ratio versus pip count, which is extremely fundamental and extremely crucial knowledge that any trader should have. Oftentimes, us as traders, we get way too invested in trying to figure out the exact strategy that we want to trade and spend hours, hundreds of hours perfecting the strategy, but we forget about some other stuff which are just as important as the strategy and as the trading psychology. So let's go ahead and jump straight into it. Consider these scenarios. Scenario number one. You've got a trading account that's $1,000. 1% risk on that account is $10. So for every trade you want to take, it's 1% risk on your account, which is $10. And the trade scenario has a 50 pip stop loss and a 500 pip take profit. And not even a 500 pip, let's say 250 pip take profit. So the risk to reward ratio is a 1 to 5. Why? Because your risk is 50 pips and your return is 250 pips. So if your risk is going to be $10, your winnings from this trade would be $50 because it's a 1 to 5 risk to reward ratio. So in this scenario, you've caught 250 pips and you've made $50. Now there's another trading scenario and it goes like this. Same trading account size, $1,000, same percentage risk, 1%, which is $10 of that account. This time your stop loss is a little bit smaller. Instead of 50 pips is, let's say, 25 pips. But let's say your target is also half of the previous target as well, so 125 pips for your take profit. This is still a 1 to 5 risk to reward ratio because your risk is 25 pips and your return is 125 pips. That's a 1 to 5 ratio, which means your earnings from this trade will be identical to the previous one. Now, these are two different trading scenarios with two different take profits. One of the take profits is literally double the other one. So in one scenario, you literally caught double the number of pips, but your earnings were the exact same in the both scenarios. So this begs the question, is calculating the wins and the losses for every trade in terms of pip count necessarily the correct thing? The reason we are going through this now is because a lot of you are either going through the transition of trading previous concepts, whatever those concepts may have been, to now transitioning into maybe some more advanced concepts, or maybe some of you have already made that transition, but you're looking for other elements to help your trading game elevate more. So I hope all of you are constantly documenting your trades. That's a massive, massive, massive factor for success in this industry. But from now on, it would be a good idea that within those documentations, instead of always just focusing on the pip count, focus on the risk to rewards. Focus on which risk to rewards did you catch and which ones did you lose. And over the months, this will give you enough data to be able to see your average monthly risk to reward. There are some more extreme scenarios as well. In many cases, you have seen that we have had sub 5 pip stop losses. But let's say in this third scenario, it's the same everything, $1,000, $10 risk, but your stop loss is 5 pips. And your take profit, in this case, is 25 pips. Your risk to reward, again, is the same thing, 1 to 5. And you've still made $50. This time, you have literally caught 10 times less pips as the first scenario, but you made the exact same amount of money. When you use risk management alongside of risk to reward correctly, these are the times that you're putting yourself at a massive mathematical advantage against the markets. Because if you're constantly catching 500 pips, let's say every single week you're catching 500 pips, but your risk on all of those trades also is around 500 pips, then your return on investment, your ROI, would not be that big because per every percentage you're risking, you're getting another percentage back. That's not that amazing. This is gambling odds. But by taking the focus away from the pip count and mostly focusing on risk to reward, you will be able to make the same amount of return on investment or the same amount of money on the trades with much smaller take profits, which means some of these trades will come to fruition a lot quicker than the other ones as well. This is a similar situation for US 30 as well. A lot of people ask me why I don't trade the Dow Jones. This is one of the reasons, because even on US 30, let's say you want to catch 1,000 pips, chances are your stop loss is still maybe going to be 100 pips, 200 pips. So your risk to reward is still going to be around a 1 to 10. Although you catch a lot more pips, the risk to reward is still the same as a trade that I could get trading, for example, GBP USD, where my stop loss would be 5 pips or even 10 pips, and the take profit would, for example, be 50 pips or more. This is still a 1 to 10 risk to reward. In one scenario, you've literally caught 950 more pips, but because you have to adjust your risk, because you have to adjust your lot sizes, the earnings would be identical. Now, I just used US 30 as an example, but obviously there's a lot more reasons why people would want to trade US 30. It's a very fast moving pair, so sometimes you will see, a lot of the times you'll see that although you make the same risk to reward, although you make the same return on investment, for US 30 it tends to come to fruition a little bit quicker as it's a faster moving asset. Does this risk to reward apply to any market? Yes, of course. It applies to any type of investment, any type of trading, and in fact in any type of entrepreneurship you always have to take into account your risk versus your reward more than the actual monetary gains. But let's speak about risk to reward a little bit more before we wrap it up. I don't want you to look at this video and the takeaway that you get from it is, hey, this means that I should always aim for a 1 to 20 or a 1 to 50 or a 1 to whatever risk to reward ratio. By no means that's what I'm saying. What I'm saying is, yes, definitely aim to have better risk to rewards, but don't take a massive jump if you haven't mastered, for example, a 1 to 10 risk to reward yet. If you haven't consistently caught maybe a 1 to 20 risk to reward ratio. By the way, if anyone's confused about what we mean by all of these risk to rewards, it simply means for every £1 or $1, for example, that you're risking, your potential return, for example, it would be $20 US. That's a 1 to 20 risk to reward ratio. But it's important to know how to document all of these risk to rewards properly. From now on all of your trading journals, put the risk to reward for every trade that you take before the analysis, and once the trade has finished, make sure to document the exact risk to reward core. Because a lot of the times it would be different once the trade is over. Not by a lot, but the little bit spreads would increase it or decrease the risk to reward here and there. All of these little things matters. Sometimes your entry might be a little bit better than the initial entry that you marked up, so your risk to reward ends up being a lot better. Once you document these consistently, after a month or two, you will have an idea about your average monthly risk to reward. You can calculate it for yourself. And the reason why it's important to know that is this is how you can document your growth. Have you grown from the previous month? Has your risk to rewards gotten better? Have you gotten more consistent for your risk to rewards? Whether or not the answer is yes or no, it doesn't matter, because if the answer is yes, then amazing. You're growing and you keep doing what you're doing and keep getting better and better. And if the answer is no, this is where you have enough documentation to go back to realize exactly where things are going wrong. Bit of an odd video today. I think a lot of you are used to me just normally going through charts, but it was important for me to speak about these concepts as well. We are here to create amazing traders at the end of the day. And for me to help you to grow to becoming a professional trader, I have to talk about these important concepts as well. And you, as someone who's looking to grow a lot more in this industry, you have to make sure you do your own independent study and all of the practice as well. But with that being said, if you got value from the video, do press the like button down below. And if you're new to the channel, press the subscribe button. Welcome to our community. For everyone who's ever asked about courses and mentorships and resources, I've just launched pipsofpersia.com. So go and check it out over there. I'm going to add some more resources in due time, but a lot of information will be given to you on pipsofpersia.com. Stay tuned for the next video out on Wednesday the 18th. It will probably be another charts breakdown for you all to give another case study. So I'll catch you all there. Let's catch some pips.